The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday the 31st of October. Welcome back, Jeremy. Good to have you here.
Hi, Gareth. Yep, good to be here. Busy week.
It's been a very busy week. Clearly, the big item this week has been the budget, so it'd be great to get your views on that. And then we can obviously talk about what's going on in the rest of the world, and in particular in the US in the run-up to their big week next week. So budget first. What did you make of it?
Well, there's lots of stuff out there, lots of commentary on it. But yeah, the budget produced a modest relief rally for London's AIM-listed shares yesterday and a bit more today as well, given they were spared the complete removal of business property relief for inheritance tax planning. So could have been worse. But the broader picture is that the outlook is now for higher inflation and higher rates, all other things being equal, which of course they never are. But the big takeaway here is that this is a big budget.
Yeah, there's a lot of spending. Yeah,
absolutely. And it consolidates the scale of the state in the UK economy through to the end of this decade. The measures announced yesterday amount to an incremental £70 billion of spending. So that's about £1,000 per person or £3,000 to £4,000 per household in the UK. And it's being financed by 40 billion of extra tax, which is a much bigger figure than most people had been expecting, and 30 billion of incremental borrowing. So these are big numbers. The other point to make is that the spending side of this is front-end loaded, which will imply a fiscal stimulus in the short term or a sugar rush for the economy and for markets, perhaps. But of course, all this, bearing in mind the borrowing increment, critically depends on the appetite for global bond investors to fund these plans.
And how have they reacted? How's it gone?
Yesterday, it was sort of steady as she goes. There was a bit of a wobble on the 10-year gilt, but we're now in a situation where the pound is below 129, having lost 4% against the dollar since September. And UK gilts are moving up. The 10-year gilt is now up above 4.5%, and that's 80 basis points higher than it was at the end of September. And the spread against the US 10-year rate is widening. Bear in mind that, further out along the curve, rates are back at or above the level they were, the 20 and 30-year during the peak of the trust debacle. So, these are pretty nervy times, I think. And I suspect as a result of this, the number 11 comms team are going to be putting a lot of effort into the coming days over the weekend to steady nerves.
So you've got the equity market sort of a bit of a relief bounce on the basis that AIM is left largely intact. And there might be some benefits from the short-term sugar rush, you described it, at the spending side of the budget. But the bond market's showing a few signs of worries about higher borrowing costs into the long term.
Absolutely. And yeah, I think it's quite interesting that both the Institute of Fiscal Studies and the Office for Budget Responsibility, they have concerns. And they have concerns around how we're going to get growth out of this. It doesn't look like we're going to get any growth in this Parliament. So it's a two-parliament strategy with underlying economic growth coming through probably quite anemically, i.e. in the sort of 1 to 1.5% range beyond 2027, 2028. So I think the questions to ask on the back of all this is, point one, does this pass the Truss Kwarteng test? And I think that's a pretty low bar, and probably the answer is yes, but we don't know. Is it from a tax perspective one and done? And I would say probably not, but hopefully. And I think near term, what is going to be the response of the Bank of England and all this? Because we've got an interesting decision to make on short-term interest rates from the Bank of England next week. We're well and truly into the world of fiscal dominance here and Biden-esque type stimulus. How you combine that with monetary policy while also remaining politically independent does really serve a bit of a curveball to the Bank of England.
They've only got a week to decide. Yeah.
Yeah.
Okay.
And I'd say the other factor here is that we haven't really heard much about the nature of infrastructure spending here. I'd say that there's sort of vague comments about improved public investment in areas such as schools, hospitals, all that good stuff. But in terms of hard and fast infrastructure plans and plans around the UK capital markets, which I think investors and the city particularly would be interested in, it's pretty thin gruel there, albeit I guess the focus now is going to be on what Rachel Reeves says in the Mansion House speech in a couple of weeks' time.
From what I saw, it was really quite vague and general in the way it was being described. And there are a few specifics that got mentioned. That the one benefit that I could see for myself out of this budget was, in fact, the Sheffield tram system, which is getting upgraded. So on my 2 or 3 times a year visit to our client Zoo Digital, based in Sheffield, it'll save me about 5 or 10 minutes of my usual walk. So that's a small productivity gain for the UK economy, but pretty limited as far as I'm concerned.
So you're a major beneficiary of this budget then?
Modest, I think, is probably the word. But your point's spot on. There's a lot of platitudes and comments about investing for growth, but there's very little detail on where those investments will be made and to the point, what the short-term or longer-term benefits are going to be and where we'll see them. So, yeah, the devil's very much going to be in the detail.
Of course, I mean, this is a budget that does have the added benefit, it must be said, of people on lower wages, with the national minimum wage being increased, and particularly for younger people on lower wages. So, it's redistributive away from older people with assets to younger people who don't have assets and who are in employment. So it's going to be interesting to see how that plays out. But in the short term, I think the impact of bond investors and will we see the return of the bond vigilantes is the big risk here.
Yeah, there wasn't a huge amount to suggest that businesses will be investing more heavily or pushing for growth or anything like that. And I think Rachel Reeves even today was admitting that the increase in employers' national insurance is going to hold back wage growth, which some might see as a good thing. Others would see as not a great thing, but it might hold back inflation, but it certainly won't be provoking too much business investment. I think that's the reality.
Well, the consolidated position of the public sector in the UK economy means the risk is the private sector gets crowded out of the investment market. And obviously they're talking a good game of trying to crowd in private investment. And I suspect, and I think the Mansion House speech is going to be interested in this regard, that we are in due course will be getting an idea of some of the measures where they might be dictating the pace of where our collective investments should be going. That's, I think, the direction of travel we're going here.
No, that's right. You're right. There might be more detail there and a few more specifics to help get us excited and back into growth mode. So great. Okay. What about more broadly? Has the rest of the world been doing anything else while we've been thinking about the budget?
There's a few other things going on. So while we've been preoccupied with the budget, we've had a collapse in oil prices due to tensions in the Middle East tempering somewhat. And we've had a bit of an emerging political crisis in Japan, where we had an election last weekend and the recently appointed Prime Minister Ishiba looks less secure following this election. So I think there's a bit of volatility there. In the real asset market, where gold has been trading at an all-time high and had a very good run and dragging silver with it, Bitcoin joined the party and moved to an all-time high this week, although I think struggling to hold that level. And we're in full swing of the US Q3 results season. And while the results that I've seen, certainly the Alphabet results and the other big tech names that have reported, seem to be broadly in line with expectations, their kind of muted sort of forward guidance statements seem to not impress. So I know as we speak, the US market is falling quite sharply at the moment, so led by the tech stocks.
Okay, so in line, but guidance a bit cautious, and that's disappointing.
Yeah. And of course, we've got the small matter of the US election ongoing and in the final phases. So, that's all to play for next week. Trump is the favourite as far as financial markets are concerned. I think the Trump trade has been in evidence in recent days. Obviously not investment advice, but if you wanted to hedge that position in some of these betting markets, I think they're only giving Harris something like a 30% chance. So that doesn't sound like a bad bet in a 2-horse race to my mind. And I think it is going to be close. So, yeah.
Well, this time next week, we might not know the answer, but we'll know whether we've had a quick result or whether the contesting is beginning. So we'll wait and see. We can talk that through next week.
So what about you? What have you been looking at in the market this week?
So it all feels a bit provincial relative to the macroeconomic swings that have been going on and the big stuff. But yeah, the UK microcap space has actually been pretty active this week. And part of it, I think, is as a direct response to the run up to the budget and people's concerns around potential changes in capital gains tax. So across the progressive client base, we've had one trading update and 3 companies have made acquisitions. So we had an update from IG Design, the gifts and packaging business. They put out a trading update, which is essentially unchanged from an update they gave a month or so ago. So business trading happily, slight improvements across the year as they've been moving through the calendar year, and cash generation has been strong. So a decent update from IG Design, well received by the market. But in terms of the acquisitions, we had Vanel, a ground engineering contractor. They've made a small acquisition, a business called Albion Drill Holdings. Virtue Motors has acquired another business called Burrows, which had 9 dealerships across the UK. And SDI, the precision instruments business and digital imaging, they've bought a precision measurement company called Inspec Vision for just under £9 million. So 3 deals, and not a progressive client, but in a similar vein, Gooch & Housego bought a business called Phoenix Precision Optics for just under £7 million. I think probably the common theme with all of those deals is that they're UK-based sellers, I'd imagine privately held or relatively tightly held, and the owners probably worrying about changes in capital gains tax in the budget of yesterday. And all those deals were completed just in advance of that potential change. So a lot of people were talking about the budget holding back investment or worrying people or causing jitters in financial markets or the investment cycles. But there are certainly 3 or 4 deals that have happened in quite short order to get them done in time to avoid risk around budgetary changes. So interesting to see that at least some deals have been happening. I'm sure there's some law firms have been quite busy over the last month or so getting those deals to the line. Be interesting to see whether that momentum carries on post the budget.
It would be interesting. It does feel as though the capital markets activity, whether it's the odd IPO here and there or M&A activity, it does seem to have a little bit more momentum to it. I know we've been saying that for a number of weeks, but I do think it's right if that is the case. But not just in the UK, but the broader global markets do seem to have slightly more risk attached to them than perhaps one would like. And I think now we're in Q4, one needs to be mindful of some of the other risks out there, but let's see.
No, that's definitely true. But it's good to see a few deals happening, and yeah, it will be interesting to see whether that does continue post the budget. So yeah, okay, good. And then next week, obviously, we've got the US election, or at least the first stages of it. Anything else on the horizon that we should be thinking about?
Tomorrow, we got the non-farm payrolls, which we did mention last week, and with the unemployment data. And there's a view that with the impact of 2 hurricanes and the Boeing strike, that this could be quite a negative number. Now, we said this last month and it was a blowout number. You know, this close to the election, a blowout negative number could be decisive. So one to watch there. We'll know about that by the time this podcast goes out. We've got US services PMI next week as well, which is again a heavy employer in the economy as a sector. So, you know, an interesting gauge for the health of the US economy. And the big events of next week are both around rate decisions on Thursday, the Bank of England and the Fed, both expected to be delivering further 25 basis point cuts to 4.75%. You know, that's going to be very interesting and consequential. What the trajectory of rate cuts is now going to look like both sides of the Atlantic as we move through Q4. I suspect, certainly as far as the UK is concerned, this trajectory of lower rates will be somewhat mitigated now.
Okay, so it's hard for the Bank of England to stick with the course they previously outlined or hoped for, given what's going on with government spending.
I think that's probably right, but let's see.
Okay. Good. Okay. Well, we'll wait and see next week. We'll be able to talk about the US election and the rate decision. So good stuff. We'll look forward to chatting to you then. Talk to you then.
All right.
Cheers.
Bye for now.
Brought to you by Progressive Equity.